If you don't understand taxes, you don't actually know how much you make. I know that sounds dramatic, like one of those lines designed to scare you into clicking. Let me earn it. Mark and Adam work at the same company, same title, same desk 2 rows apart, same salary on paper, $90,000 a year. If you asked either of them what they make, they'd both say the same number without thinking about it. 90 grand. And both of them would be wrong, because the number on the offer letter is not income. It's a starting point. It's the price before the real transaction happens. By the end of this video, Mark and Adam are going to take home amounts that are thousands of dollars apart on the exact same salary. And the only difference between them is that one of them understands the machine and the other one just hopes it works out in April. I want to walk you through that machine slowly because once you've seen how it actually works, you can't unsee it. And you'll never look at your own paycheck the same way again. Quick disclaimer before we go anywhere. I'm not a financial advisor, and this isn't financial advice. This is education. The numbers I'm using are based on the United States federal tax system for a single filer in 2024 and tax law changes, so your decisions are your own. But the principles underneath this, the way the system is built, those don't change much from year to year, and they're the part that matters. Let's start with the single most important idea in this entire video, and it's the one almost nobody gets right. There is gross income and there is net income, and the gap between them is not small, and it is not random. Gross is the headline number, the 90,000. Net is what actually lands in your bank account and becomes yours to spend, save, or invest. Most people think the difference between those two is just taxes, some vague chunk the government takes. But it's not one chunk. It's a stack of separate deductions, each with its own rules, and if you don't know what's in that stack, you are flying blind on the single biggest expense of your entire life, because that's what taxes are. Over a career, you will pay more in taxes than you'll spend on your house, your cars, and your education combined. It's the largest purchase you will ever make, and most people never read the receipt. So let me show you the receipt. Mark makes $90,000. The first thing that comes out before income tax even enters the conversation is what's called FICA. That's Social Security and Medicare. Social Security takes 6.2% of his wages, and Medicare takes another 1.45%. Add those together, and that's 7.65% that comes off the top, no matter what, before any of the clever stuff. On $90,000, that's about $6,885 gone, and you never even see it. It's withheld before the paycheck is cut. Here's the part most people don't realize. Your employer pays that exact same 7.65% again on your behalf. You don't see it on your stub, but it's part of the cost of employing you. Economists will tell you that money would have been your wages if the tax didn't exist. So the real tax on your labor for Social Security and Medicare is closer to 15.3%. It's just that half of it is hidden from you by design. Hold on to that idea, because hidden taxes are a theme today, and once you start counting them, the picture changes. Now we get to the part everyone thinks they understand, and almost nobody does. The federal income tax and the magic word brackets. Here's the single biggest myth in personal finance. And I need you to hear this clearly, because believing the myth costs people real money and real opportunities. The myth is that if you move into a higher tax bracket, all of your income gets taxed at that higher rate. People say things like, I don't want that raise, it'll bump me into the next bracket, and I'll actually take home less. That is false. It is mathematically impossible under the way the system is built. Let me earn that, because this is the foundation everything else sits on. The United States uses a progressive marginal tax system. Marginal is the word that saves you. It means your income is poured into a series of buckets, and each bucket is taxed at its own rate. Only the dollars that land in a higher bucket get taxed at the higher rate. The dollars in the lower buckets keep their lower rates, always. So picture it like filling a set of glasses stacked from shortest to tallest. The first glass fills up and gets taxed gently. The water that overflows into the second glass gets taxed a little more, and the third glass a little more than that. But the water already sitting in the first glass never gets retaxed when the second one starts filling. Your raise can never make your total take-home go down, because the only thing taxed at the higher rate is the new money on top. Let me put real 2024 numbers on it for a single filer so it stops being abstract. The first roughly $11,600 of taxable income is taxed at 10%. The next chunk, up to about $47,150, is taxed at 12%. After that, up to about $100,525, you're at 22%, then 24%, then 32%, then 35%, and the very top rate of 37% only kicks in above roughly $609,000. So when someone making $90,000 says, I'm in the 22% bracket, they think they're paying 22% of everything. They're not even close. Only the dollars above $100,525 would hit 22%, and they don't even earn that much in taxable income. Most of their money is being taxed at 10% and 12%. This is where the two numbers everyone confuses come in, and understanding the difference is the difference between someone who sounds smart at a dinner party and someone who actually controls their money. There's your marginal rate, and there's your effective rate. Your marginal rate is the rate on your next dollar, the top bucket you've reached. Your effective rate is the rate you actually pay across all your income, the blended average of all those buckets. They are almost never the same number, and the gap between them is enormous. A person who says they're in the 22% bracket might have an effective federal rate of 12% or 13% once you blend everything together. When you assume your bracket number is what you actually pay, you overestimate your tax burden, you get scared of raises, and you make smaller, more timid decisions about your career and your money than you ever needed to. The myth makes you poor, not because of the tax, but because of the fear. Let me actually run Mark's full number so you can see the machine produce its output. Mark makes $90,000 in gross wages, and he does the thing most people do, which is nothing. He takes the standard deduction, which in 2024 is $14,600 for a single filer, and that's it. So his taxable income isn't $90,000, it's about $75,400. Already you can see the headline number was a lie. Now we pour that $75,400 through the buckets. 10% on the first $11,600 is about $1,160. 12% on the next chunk, up to $47,150, is about $4,266. 22% on the remaining piece, from $47,150 up to $75,400, is about $6,214. Add those three together, and Mark's federal income tax is roughly $11,640. On $75,400 of taxable income, that's an effective federal income tax rate of about 15.5%. And on his full $90,000 gross, it's about 13%, not 22. 13, sit with that gap because the whole game lives inside it. Now we have to add back the FICA we talked about, the $6,885. And depending on where Mark lives, there's a whole other layer we haven't touched, state income tax. If Mark lives in a state like Texas or Florida or Washington, his state income tax is zero. If he lives in California or New York, it could be another $4,000 to $6,000 on top of everything. That's not a small detail. Two people earning the identical $90,000, one in Austin and one in Los Angeles, can have take-home pay separated by $5,000 or $6,000 a year, purely because of which side of a state line they sleep on. Same job, same effort, same skill. The geography is a tax. People will agonize over a $2 coffee and then never once factor in that their zip code is quietly charging them a 5-figure annual fee. I'm not telling you to move. I'm telling you to know the number because you can't make a real decision about a job offer in another state until you compare net to net, not gross to gross. A $95,000 offer in California can be a pay cut from an $85,000 offer in Texas, and the recruiter will never tell you that. So let's total markup, and let's keep it simple and assume he's in a no-income tax state to isolate the federal picture. $90,000 gross, minus about $11,640 in federal income tax, minus $6,885 in FICA. Mark takes home roughly $71,475. His combined effective tax rate, everything in, is about 20.5%. So the $90,000 man is really a $71,000 man, and he probably has no idea because he's never done this math. He just knows the paycheck feels smaller than the offer letter promised, and he files that feeling away as one of those things adults just accept. Now, here's where it gets interesting, because this is the exact point where Adam walks back into the story. Adam makes the same $90,000, same FICA, no escaping that. But Adam understands one thing Mark doesn't. The tax system is not just a set of rules that happen to you. It's a set of rules that responds to you. The entire code is full of deliberate levers written into law on purpose that let you legally lower the amount of income the government is even allowed to count. This is the line that separates the two men, and it's worth naming clearly. There is a difference between tax evasion, which is illegal, which is lying about what you earned, and tax avoidance, which is using the rules exactly as they were written to keep more of what's yours. Every dollar I'm about to describe is the second kind. This is the stuff the wealthy use constantly, and the average earner usually ignores, not because it's hidden, but because nobody ever sat them down and explained it. Adam does the simplest, most powerful thing first. He contributes to his 401k. In 2024, he can put in up to $23,000 of his own money, but let's say he does $12,000 to keep it realistic. That $12,000 comes out of his income before the government calculates his tax. It's pre-tax. So Adam isn't taxed on $90,000 minus the standard deduction. He's taxed on $90,000 minus $12,000 for the 401k minus the $14,600 standard deduction. His taxable income drops to about $63,400. Watch what that does. The $12,000 he sheltered would have been sitting in his 22% bucket at the top of his stack. So by moving it into the 401k, he doesn't save 13%, his effective rate. He saves at his marginal rate, 22%. That $12,000 contribution cuts his federal tax bill by about $2,640. Read that again. He moved $12,000 from a checking account he'd probably spend into an investment account that's his, that grows for decades. And the government effectively chipped in $2,600 to help him do it. That's not a loophole. That's the system working exactly as designed, rewarding the behavior it wants to encourage. And this is the deepest insight in the whole video, so let me slow all the way down. Deductions are worth more the higher your bracket, because a deduction saves you money at your marginal rate, your top rate, not your average rate. When Adam shelters $1, that dollar would have been taxed at 22%, so sheltering it is worth 22 cents. This is why the tax code feels like it favors people who earn more, because in a very real way, it does. The higher you climb, the more each deduction is worth, and the more incentive you have to learn the levers. The cruel irony is that the people who could most use the help, the ones earning less, get the smallest benefit from each deduction, while the people who need it least get the biggest. I'm not here to tell you that's fair. I want to be honest about that. I'm here to tell you the rules are the rules, and choosing not to learn them doesn't make the game more fair. It just means you're the only one at the table playing with your cards face up. Adam doesn't stop at the 401k. He also has a high deductible health plan, which means he qualifies for an HSA, a health savings account. And the HSA is, mathematically, the single best account in the entire American tax code. Nothing else even comes close. Here's why. Almost every account makes you a deal. You either get a tax break going in, like the 401 cash, or coming out like a Roth, but never both. The HSA breaks that rule. The money goes in pre-tax, lowering your income just like the 401k. It grows tax-free, no taxes on the gains while it sits there. And if you spend it on qualified medical expenses, it comes out tax-free too. In, growth, and out, all untaxed. Triple tax-free. There's no other account in the system that does all three. Adam puts in $4,000, and that knocks another roughly $528 off his tax at his 12% bucket level, while building a medical war chest that will compound for decades. Most people treat the HSA like a glorified flex account they have to spend by December. The ones who understand it treat it like the best retirement account they've ever been handed, because after age 65, it functions almost exactly like one. So let's see where Adam lands. Same $90,000 gross. But his taxable income after the 401k, the HSA, and the standard deduction is down around $59,400 instead of Mark's $75,400. Run that through the buckets, and Adam's federal income tax comes out around $7,800 compared to Mark's $11,640. That's a difference of roughly $3,800 in tax, vanished, completely legally, on the identical salary. And here's the part that should make the hair on your neck stand up. Adam didn't lose that $16,000 he sheltered. It didn't disappear. It went into accounts that are still his, growing for his future. So Adam has a lower tax bill and more wealth, at the same time, from the same paycheck, as the guy sitting 2 rows over. Mark spent the year telling himself he couldn't afford to save. Adam understood that the saving is what made the tax bill shrink, which freed up even more to save. One man is on a treadmill. The other man built a snowball, and the tax code is helping him push it downhill. Now, I know what some of you are thinking, and you're right to think it, so let me handle it head on before we go further. You're thinking, Adam locked that money away. He can't touch the 401k until he's 59 and a half without a penalty. Mark at least has his money now. That's a fair counter-argument, and if I only showed you the upside of sheltering everything, I'd be doing exactly what the get-rich-quick crowd does. So let me be honest about the trade-off. Yes, the 401k and the HSA have rules about when and how you access the money. That's the deal you make in exchange for the tax break. The system isn't giving you $2,600 out of generosity, it's renting your patience. But here's the thing most people miss in that objection. Nobody is telling you to shelter every last dollar and live on crumbs. The smart move isn't all or nothing, it's a layered approach. You keep an emergency fund in cash that you can touch tomorrow. You shelter enough to capture the obvious wins, especially any employer 401k match, which is a 100% instant return you will never beat anywhere else. And then you balance the rest based on your actual life. The mistake isn't sheltering money. The mistake is doing zero because you were afraid of locking up everything when those were never the only two choices. Let me zoom out, because there's a bigger pattern here that goes way beyond Mark and Adam, and it's the real reason I wanted to make this video. The way the tax code treats different kinds of money is wildly, almost unbelievably different. And once you see it, you understand the actual structure of how wealth works in this country. Mark and Adam both earn what's called ordinary income, wages. money you get from trading your hours for dollars. Ordinary income is taxed at the highest rates the system has, the full bracket schedule we just walked through, all the way up to 37%, plus the FICA on top. It is, bluntly, the most heavily taxed kind of money there is. The way most people earn a job is the way the code taxes the hardest. Now compare that to how investments are taxed. When Adam's investments grow and he eventually sells something he's held for more than a year, that's a long-term capital gain, and long-term capital gains have their own separate, much lower set of rates. 0%, 15%, and a top of 20%. Let that sink in. A person can earn money by working and pay a marginal rate of 32%, while another person earns money by owning, by letting assets appreciate and selling them, and pays 15%. Same dollar amount of income, less than half the tax, purely because of what kind of income it is. This is the thing that quietly explains so much. It's not that the wealthy are cheating. It's that, past a certain point, their income stops coming from a paycheck and starts coming from ownership, and the code taxes ownership far more gently than it taxes labor. Qualified dividends get those same low rates. This is the lever that compounds across an entire lifetime, and it's why make your money work for you isn't just a motivational poster. It's a literal description of a tax category. The dollar you earn working is taxed harder than the dollar your money earns sitting in an index fund. That is not an accident. It is the architecture. Which brings me to the deepest reframe I can offer you, the one I hope you actually take with you. We've been talking this whole time about income as if it's the number on your paycheck. But your real income, the only number that actually matters for your life, is what you keep and what you can grow. Two people with the identical gross salary do not have the identical income, not in any way that affects how they actually live. The person who understands the machine and the person who doesn't are not earning the same amount, no matter what the offer letter says. Your real income is gross, minus every tax you can avoid, plus every tax you legally can. And almost nobody calculates it, because the system is designed so the only number you ever see prominently is the one before all the subtraction happens. So what do you actually do with all of this? Because I don't want this to be one of those videos where you nod along, feel a little smarter for 10 minutes, and then change nothing. Take the habit with you. Here's the habit. First, find your actual effective tax rate. Pull your last tax return, take the total tax you paid, and divide it by your total income. That one number, the real percentage, is more useful than any bracket you've ever quoted at a party. And I'd bet money it's lower than you assumed, and that you've been carrying around a scarier number in your head for years. Second, figure out your marginal rate, your top bracket, because that's the rate every deduction is worth to you. And it tells you exactly how much each dollar you shelter actually saves. Third, capture the free money first. If your employer offers a 401k match and you're not getting all of it, you're turning down a raise, full stop, and no investment return on earth beats an instant 100%. Fourth, learn whether you have access to an HSA, because if you do and you're not using it, you're walking past the single best account in the entire code. And fifth, before you ever compare two job offers or think about moving, compare them net to net, with state taxes included, because gross to gross comparisons are how people accidentally take pay cuts that look like raises. Let me leave you the way these things usually shake out, because there are really only three paths in front of you from here. The first path is the fantasy one, the one sold by people who promise you secret offshore tricks and magic loopholes that make taxes disappear entirely. That path is mostly a scam, and it ends in an audit or a course you didn't need. Ignore it. The second path is the cynical one, the voice that says, the whole system is rigged against you, so why even bother learning it? Just resign yourself to whatever lands in the account and stop looking at the receipt. I understand that voice, but it's the most expensive one of all because the system isn't rigged against people who learn it. It's rigged against people who don't. The third path is the quiet one, and it's the only one that actually works. You don't need to become an accountant. You just need to stop treating taxes as a mysterious force that happens to you in April and start treating them as the largest, most controllable expense in your life. You learn the handful of levers we talked about. You pull the ones that fit your situation, and you check your real income, not your fantasy income, when you make decisions. Whether you ever do anything fancy with this or not, take that one habit with you. The offer letter is not your income. What you keep is your income. Learn the difference, and you will quietly out-earn people who make more than you for the rest of your life. Thanks for watching, and I'll see you in the next one.